There is a massive, glaring disconnect in the market right now, and it is basically hiding in plain sight. Look, if a company's underlying transaction volume is growing at an explosive rate, you'd naturally expect the stock to follow suit, right? But what happens when that exact same company sees its stock absolutely plunging, creating this huge valuation tension? That's the exact setup we're looking at today with dLocal. We've got this rapidly expanding digital infrastructure toll booth operating across the global south, yet the market has been aggressively selling it off.
Okay, let's just get straight to it, because this number is the anchor for the entire story. 73%. That is dLocal's total payment volume growth year over year for the first quarter of 2024. They hit a massive $14.1 billion. I mean, just let that sink in for a second. We're looking at an economic engine expanding that rapidly, and yet the stock is sold off to a compressed 22.3x price-to-earnings multiple. That's a huge fall from its post-IPO highs when it was trading at over 290x. So the really crucial question we have to answer here is, why is a company growing its core volume by 73% suddenly being priced like a stagnant utility? Well, to understand the disconnect, we first have to understand the engine itself.
So dLocal operates on a concept they call one dLocal. Basically, they provide a single API, an application programming interface, that gives global enterprise merchants direct access to over 600 local payment methods across some highly fragmented emerging markets. You can think of them as this giant compliance shield and payment gateway for G7 giants. Companies like Amazon, Netflix, Microsoft, Uber, they use dLocal so they don't have to build localized banking relationships or navigate tricky capital controls or figure out domestic tax laws in over 60 different countries across Latin America, Africa, Asia, and the Middle East. See, emerging markets largely bypass traditional credit cards. They favor mobile money and instant bank transfers. By plugging into dLocal, these tech giants instantly lift their conversion rates by up to 20 percentage points without having to hire this massive global compliance team.
But there is a massive structural shift happening underneath the hood here. Historically, dLocal made most of its money on cross-border processing. That carries higher profit margins because they collect foreign exchange spread fees. But look at Q1 2024. Local-to-local volume, which is where dLocal collects and settles in the exact same local currency, grew 101% to $7.7 billion. It has now completely outpaced cross-border volume, which grew at 49% to $6.3 billion. This shift is really being driven by high-velocity sectors. Things like on-demand delivery and ride-hailing, where consumers are using local payment rails. This is the core economic engine driving the business today, and is literally changing the company's entire margin profile.
And this brilliantly illustrates their strategic moat and their growth initiatives for the future. They're rolling out what is colloquially known as the Stablecoin sandwich. It's through a partnership with Stablecoin. So, for business-to-business cross-border payments, dLocal takes the local fiat currency, converts it to a stablecoin, moves it globally across a blockchain in seconds, and then off-ramps it right back into the destination fiat. This completely bypasses the slow, clunky correspondent banking network. We're talking about reducing transaction fees from up to $52 down to under $1 single, and it cuts settlement times from days to just mere minutes. That is a massive competitive advantage.
So we have this incredible moat, 73% volume growth, and these highly sticky enterprise customers showing net revenue retention of over 140%. If the growth engine is running this hot, why did the market panic? Why did the stock drop 13% in a single day right after their Q1 2024 earnings release on May 14th? Let's uncover exactly what spooked Wall Street.
The immediate catalyst for the sell-off was a $9.7 million prior period tax adjustment. This was a retroactive tax hit that covered installment payment products spanning 2023 through 2024. Now, this one-off adjustment caused dLocal to miss consensus earnings estimates by roughly 3 cents per share. But here is what really jarred investors. This tax hit exacerbated a pretty painful net income margin compression. It dragged reported net margins down from 22% a year ago to just 12% in Q1 2024. The market looked at shrinking margins, they saw an earnings miss, and they just hit the sell button. But the market's fear wasn't just about taxes, right? It was also about cost bloat. In Q1, their normalized operating expenses spiked 58% year over year. Management was aggressively investing for future scale, but it choked their near-term profitability. The good news is, management is actively responding with some calculated discipline. CFO Guillermo Perez addressed this head-on. He declared a net hiring freeze for the rest of 2024 and initiated automated productivity programs. They are actively promising to improve operating leverage in the second half of the year. That's a major signal that they are pivoting from aggressive spending back to core cost control.
Let's move over to the financials to see how this builds into the raw evidence. Honestly, the top line is stunning.
Q1 24 revenue came in at $335.9 million. That's up 55% year over year. Gross profit hit a record $118.7 million, growing 40%. But you have to look at that last line. Adjusted free cash flow absolutely collapsed. It fell 63% down to just $14.7 million. Now, this drop was largely driven by temporary working capital headwinds. Specifically, it was the timing of tax credit nettings and higher outstanding receivables from funding advancements. The underlying business is definitely still generating cash, but this quarterly timing mismatch severely spooks short-term investors.
Now, for what it's worth, management fully expects these working capital effects to completely reverse in subsequent quarters as the timing issues normalize. And by the way, if you like deep evidence-based stock breakdowns like this that look past the market's initial panic, make sure you're subscribed.
Okay, let's synthesize all this into our qualitative scorecard to really judge the overall health of the business. The extremes here are fascinating. Financial health scores a stellar 9 out of 10. Why? Because their asset-light balance sheet is holding $815.6 million in cash against just $90 million in total debt. They're loaded with cash. However, their public track record scores a 6 out of 10. The company has faced some serious volatility, from Argentine capital controls restricting funds in the past to a muddy water short report back in late 2022. Revenue quality sits right in the middle at a 7 out of 10. It's anchored by incredibly sticky enterprise clients, but dragged down slightly by heavy merchant concentration and the currency volatility of emerging markets.
When we roll up all the qualitative factors, including their strong management alignment and a really solid growth outlook, we get a blended score of 7.6 out of 10. So the overarching narrative here is that dLocal is a highly viable, extremely resilient growth engine. It's just currently experiencing the growing pains of transitioning to lower margin, high volume, local-to-local transactions. The business quality remains fundamentally strong, for sure, but that transitioning phase is exactly where the friction lies.
Quick note before we move on to the forward-looking models. All of the research behind this explainer was created using Flash by StockSentinel.ai. You can actually generate deep research reports exactly like this one for literally any public company in the world, completely free at FlashStockSentinel.ai. The core company research is free, but if you want an ongoing investing edge, Flash has a premium feature called Best Ideas Now. Every single week, it surfaces the highest conviction ideas across 3 investor styles: long-term compounders for quality businesses built to compound for years, hidden gems for under-the-radar names with asymmetric upside, and dividend hunters for durable income with the fundamentals to back it up. There's also Portfolio Watch, which monitors your portfolio and flags important changes, and Insider IQ, which tracks meaningful insider buying activity worldwide. You'll see a QR code in the bottom right of this video. Scan it to download the Flash app and try it yourself, or just access Flash on the web at flash.stocksentinel.ai. And remember, pricing is going up over time, but once you lock in your subscription, your price never increases.
Okay, let's shift gears and look at the future. Before we jump into the numbers, I want to clearly state this is a hypothetical framework for thinking about possible outcomes over the next 5 years. It is not a prediction, and it is absolutely not financial advice. The stock could go much higher or much lower than any of these scenarios. Let's look at the math.
So using their full year 2025 base, we built 3 scenarios looking out to 2030. At a current price of $14.08, our low case projects a drop to $8.34, assigning a 12x PE multiple. The base case projects a share price of $31.10 at a 20x multiple, and the bull or the high case targets $68.75 at a 26x multiple. Now, when we apply subjective probability weights to these, so 20% for the high, 60% for the base, and 20% for the low, the probability-weighted target points to $34.08. But look, price targets don't really mean much without the operational logic behind them, right? So let's break down exactly what has to happen in the real world to make each case a reality.
For that high case to hit, dLocal must aggressively scale their B2B stablecoin rails and successfully expand into the Middle East. That needs to drive revenue to over $3.7 billion by year 5, with net margins recovering back to 19%. This also relies on management executing their $300 million share buyback and really optimizing their automation. In the base case, they just maintain market share against regional players, achieving a 20% revenue growth compounder with margins settling at around 16% as competitive pressures are perfectly balanced by their new efficiencies. And in the low case, well, the thesis breaks. Revenue growth slows to 12%, price wars with regional specialists drag margins all the way down to 11%, and the buyback program gets paused. If you want to access the full model with all the detailed assumptions for each scenario, you can check out the detailed research report at flash.stocksentinel.ai.
Because that low case is a very real possibility, we need to talk about risk. We've organized these early warning signs by time horizon. In the short term, looking at the second half of 2024, investors absolutely must watch for operating expense recovery.
If margins don't bounce back to that 17 to 18% range, the business model may be structurally shifting to a low-margin utility. Ongoing, the metric you want to watch is net revenue retention. If NRR drops below 130%, it means major clients are churning, or worse, they are building direct bank networks themselves. And long-term, the real disruptive threat is central bank digital currencies, or CBDCs. They could create direct cross-border corridors that bypass payment gateways entirely.
And we definitely have to highlight the most severe threats currently on the board. Customer concentration is a massive vulnerability here. In Q1 2024, dLocal's top 10 merchants accounted for a staggering 61% of their total revenue. If just one of those G7 giants negotiates lower pricing or decides to leave, the impact is immediate. Add to that the severe foreign exchange volatility inherent in emerging markets. Just as an example, in late 2024, an 80% revenue decline in Nigeria was driven entirely by currency devaluation. Finally, regional price competition is heating up fast. Specialists like eBanks in Latin America or Flutterwave in Africa are fighting for the exact same enterprise clients. That could easily force dLocal to compress its take rates even further to compete.
There's also a really nuanced risk happening inside the boardroom. We have a fascinating capital allocation conflict right now. On one hand, the board has authorized and is actively executing an aggressive $300 million share buyback program right alongside paying a $57 million dividend. That signals massive confidence in their cash position. But on the other hand, recent filings show intent from director Sebastian Kanovich to sell 1 million shares. It creates this weird tension. Corporate cash is buying, while a key insider is taking chips off the table. It's an early warning sign that is definitely worth monitoring closely.
So let's bring this all together. What is the real story here? Well, dLocal is a high-growth toll booth in the global south. The market's panic over shrinking margins and a one-off tax hit has completely masked the reality of a company generating 73% underlying volume growth. Yes, the shift to local volume is putting near-term pressure on margins, but it is deeply entrenching dLocal into the high-velocity economies of the future. The single biggest thing to watch next is their operating leverage in the second half of 2024. If the hiring freeze and automation work, that margin pressure lifts. Now, if you want the full research, including the deeper framework behind this explainer, you can get it free at flash.stocksentinel.ai. The transition to local payments will define dLocal's next decade, but the ultimate question is, can they fix their margins before the competition catches up? Until next time, do your own research, and I'll see you in the next one.
Check out Flash at flash.stocksentinel.ai to access free research and videos like this one for any company in the world.